Good morning to the most incredible XRP army. I'm gonna waste no time, let's get right into the video. Let me tell you something that should make everyone in their chair sit up right now. If you hold XRP or are planning on getting any amount of XRP, you need to hear this. This is one of those moments where the real story is hiding in plain sight. And if you blink, you miss it. There's a reason Bitcoin isn't sitting at some absurd number already. And it has nothing to do with a lack of interest or belief. It has everything to do with how power, leverage, and balance sheets interact when traditional finance collides with a hard asset. What caused this huge death spiral for Bitcoin, and is it about to fully recover? To the amazing viewers, kick back, get comfortable, smash the like and subscribe button, so this video reaches other legends just like you. Now, let's get right into the video. There's been a growing theory floating around that banks are quietly suppressing Bitcoin. And on the surface, it sounds like conspiracy talk. But when you actually dig into the mechanics, it becomes less about secret meetings and more about incentives lining up in uncomfortable ways. The MicroStrategy situation is the perfect lens to understand this. You have a publicly traded company whose primary mission is not software, not innovation, but acquiring and holding Bitcoin. When the market prices that company below the value of the Bitcoin it holds, something very strange happens. Investors can effectively buy Bitcoin at a discount by buying the stock. That mismatch alone tells you the market is under stress, not confused. To understand why this matters, you have to zoom out and look at history. Financial systems don't usually collapse because of one bad decision. They collapse because of feedback loops. Empires, governments, and corporations all fall victim to the same pattern when debt is structured in a way that removes flexibility. When obligations are denominated in something you can't control and liquidity dries up, the spiral begins. It doesn't matter whether that unit is gold, foreign currency, or a volatile asset like Bitcoin. Once the system locks you into fixed payments with shrinking options, the outcome becomes predictable. The Ottoman Empire learned this lesson the hard way. They borrowed heavily in gold-backed obligations, assuming growth would always cover the cost. When credit conditions tightened and their currency weakened, they couldn't roll their debt. Gold didn't become more valuable. Their currency became weaker, but the effect was the same. Eventually they defaulted, and the lenders didn't just want repayment, they wanted control. Taxes, revenues, and sovereignty slowly slipped away. This wasn't punishment, it was math. The lender always seeks certainty when the borrower loses it. Fast forward to modern times and the pattern repeats, just with cleaner branding. Greece didn't lose control because of corruption alone. It lost control because it borrowed in a currency it couldn't issue. When growth stalled and borrowing costs exploded, the solution wasn't mercy, it was asset seizure through structured funds. Ports, utilities, and infrastructure were sold to satisfy debt. Again, not malice, just structure. When debt is senior and liquidity is scarce, ownership changes hands. This is the blueprint, and it applies just as easily to corporations as it does to nations. Now bring this framework back to MicroStrategy. On paper, the company looks incredibly safe. Massive Bitcoin holdings, relatively modest debt, and a low loan-to-value ratio. That's the surface view, and it's intentionally comforting. But safety isn't just about totals, it's about cash flow timing. MicroStrategy has obligations that don't care about Bitcoin's long-term thesis. Interest and preferred dividends must be paid on schedule, regardless of market sentiment. Those payments require dollars, not conviction. The critical detail most people gloss over is that preferred dividends cannot simply be turned off. They are contractual. That means MicroStrategy must maintain a cash buffer large enough to service these payments for years. Right now, they've built that buffer through equity issuance when the stock trades at a premium. This works beautifully when markets are optimistic. Investors overpay for exposure. The company raises cheap capital, and the cycle reinforces itself. But this mechanism only works in one direction. When the stock trades below the value of the Bitcoin it represents, issuing equity becomes destructive. Selling shares at a discount effectively means selling Bitcoin cheaply. At that point, the company switches strategies. Instead of selling stock, it relies on its cash reserves. That's fine temporarily, but those reserves are finite. Once they deplete, the only remaining source of liquidity is the Bitcoin itself. That's where the spiral risk appears, not because Bitcoin is bad, but because forced selling creates pressure regardless of fundamentals. This is why the term death spiral exists. Selling Bitcoin to cover obligations pushes the price down. A lower price reduces the company's perceived value, making equity issuance even less attractive. That forces more reliance on selling assets, which further pressures the market. It's a feedback loop that has nothing to do with belief and everything to do with liquidity. Even the strongest asset can become a liability if it's the only thing left to sell. So where do banks come into this? Not through some coordinated villain plot, but through positioning. Large institutions hedge risk. If they see a structure where price suppression benefits their entry point, they may take positions that align with that outcome. Shorting equity, publishing negative research, or simply waiting patiently can all serve the same purpose. The goal isn't to destroy Bitcoin, it's to acquire exposure under favorable conditions. That's how institutions behave. They don't chase, they wait. It's also important to understand that multiple independent actors can create the appearance of coordination without ever speaking. Hedge funds, banks, and traders respond to the same signals. If suppressing volatility or price benefits them in the short term, they will act accordingly. That doesn't require conspiracy, just aligned incentives. When enough capital moves in the same direction for the same reasons, the result feels intentional, even if it's emergent. Despite all of this, it's critical to separate structural risk from asset quality. Bitcoin itself doesn't fail because a holder mismanages leverage. The network doesn't care who owns it or why. The risk discussed here is about intermediaries, not the asset. That's why long-term holders often grow more confident during periods of uncertainty. Stress reveals who is forced to act and who can remain patient. Volatility becomes a filter, not a flaw. What this ultimately explains is why Bitcoin's price can feel artificially restrained during periods of apparent strength. It's not that demand isn't there, it's that supply dynamics and balance sheet mechanics are absorbing it. Over time, these structures either resolve cleanly or they unwind violently. There's rarely a middle ground. The market doesn't negotiate with math, it complies with it. The final takeaway is simple but uncomfortable. Systems built on leverage always look strongest right before they're tested. Whether MicroStrategy navigates this perfectly or not, the broader lesson remains. When traditional finance interacts with hard assets, friction is inevitable. Those who understand the mechanics stay calm. Those who don't, panic. Bitcoin doesn't need to rush. Time favors the asset, not the structures built around it. We are one of the greatest XRP communities on YouTube today, and it's all because of you. Your comments, your likes, your support, your energy. It is so amazing to see. Check out the pinned comments for our free XRP course. I appreciate all of you legends. See you in the next video.